If you're a small business owner making real money, here's the line you need to hear clearly. The IRS rules that decide whether your IUL stays tax-free are rigid, irreversible, and completely indifferent to your intention. And in a minute, you'll see why some of the worst tax outcomes don't come from aggressive behavior. They come from well-meaning owners who simply move too fast with the wrong strategy. This matters if your income is strong, but uneven, if your wealth lives inside your business, and if you don't have an employer 401k quietly absorbing mistakes in the back. Because once the IRS classification breaks, it doesn't bend, it locks. So stay with me. This is where most high earners get burned, and they don't realize it until it's too late. Hello, my name is Robert Balgac. I'm a founder and CEO of Black Swan Insurance Group. And since 2017, we've helped over 20,000 families design tax-efficient wealth structures, and we've earned 800 plus 5-star Google reviews by doing one thing consistently: respecting the math and respecting the rules. We don't sell Index Universal Life as a product. We design it as a structure. So if at any point you want to see how this applies to your situation, you can click on the link below and you can book a tax-free wealth strategy session with us. Calm, precise, no hype, just math. Because in a moment, I'm going to show you why two IUL policies can live under the same IRS code and still end up completely different tax realities. But first, let me introduce you to Joe. Joe is 39 years old. He owns an HVAC company in a growing metro area. His income averages around $280,000 a year, but it's uneven, weather-driven, contract-driven, crew-dependent. No employer retirement plan, no pension, no backstop. Just cash flow and responsibility. And Joe isn't reckless with money. He's cautious. He remembers watching his uncle lose half of his retirement back in 2008. He remembers the phone call, the silence, and the realization that working longer suddenly became the plan. And that image stuck. So Joe avoided obvious mistakes. He didn't gamble, he didn't chase returns, but everything still felt fragile. Then came the near mistake. And this is crucial. Joe landed a one-time commercial HVAC job. After expenses, he dropped about $350,000 clean into his business account. Strong year, big check, heavy taxes. Joe's instinct was logical. Let's just put this into an IUL and be done. Not aggressive, not sneaky, just efficient. And this is exactly where the IRS rules start deciding outcomes. Because in a minute, you'll see how doing too much of the right thing too fast can permanently destroy tax-free retirement. IRS 7702, the line you can't redraw later. This is where policies qualify or quietly fail before they even get going. IRS code 7702 answers one question only. Is this contract legally life insurance? He doesn't care about your goals. He doesn't care about your illustration. He defines the relationship between premium, cash value, and debt benefit. Internally, we call 7702 the chassis. And if the chassis is wrong, the engine doesn't matter. Joe will show two designs. One with razor-thin debt benefit, optimized for early cash value, and one with a wider corridor, slower early growth, and structural market. Same policy, same index, same insurance company, completely different outcome. Why? Because design determines the outcome. IUL isn't magic. It's math. Under tax code 7702, the geometry is locked at issue. You don't get to fix it later without consequence. Every future dollar inherits that original design decision. And here's what makes this dangerous. Most policies that violate 7702 still look fine for years. They don't fail loudly. They fail silently. This is where most high earners get burned because the illustration looks efficient, but the structure is fragile. And in a minute, you'll see why fragility becomes fatal when funding accelerates. IRS 7702A, when a good year creates a permanent problem. This is where one great year quietly ruins the tax strategy. Joe's $350,000 windfall after tax created a problem most advisors never talk about. 7702 governs whether a policy becomes a modified endowment contract, a MEC. And once a policy MECs, the tax treatment flips permanently. Loans become taxable, distributions become last in, first out. Penalties may apply. There's no appeal process. And Joe's instinct to put the entire $350,000 all at once would have failed the 7-page test immediately. And that's the real lesson. The IRS punishes speed, not intent. Joe wasn't trying to exploit anything. He was just trying to clean up a strong year. But permission-based money is fragile money. And the IRS does not care why the money showed up, only how fast it goes in. This wasn't a loophole, it was a rule. And before we go any further, just ask yourself this. Do you actually know your policy's 7-pay limit? Because if you don't that answer, you're closer to the line than you think. And in a minute, you'll see how we slowed the money down without giving up control. Now, let me interrupt the tax discussion with reality. About 2 years after Joe's policy was issued, the business hit a convergence of issues: a delayed commercial payment, equipment replacement, payroll stacking up in the same month. Nothing catastrophic, but enough to challenge the budget. Joe didn't want to sell assets. He didn't want to tap a line of credit. And the market wasn't exactly inviting. That's when IUL policy really mattered. Not as a retirement tool, but as a liquidity savior. Joe accessed policy loans against his accumulated value and was able to withdraw $50,000. No taxable income, no approval process, no forced timing. This was the moment he realized something critical. Liquidity isn't about returns. It's about access when life interrupts the plan. And this only worked because the policy never crossed the 7702A line. And in a minute, you'll see exactly how that was engineered. The solution: slowing the money without losing control. We didn't say no to the $350,000. We just refused to let it break the structure. Instead of forcing the entire windfall into the policy at once, we built the solution in layers. First, the IUL was designed for maximum non-MEC funding over 7 years, $50,000 per year, totaling $350,000. That pacing mattered. It kept the policy fully compliant under 7702 and 7702A, preserving tax-free access later. Second, the entire $350,000 didn't just sit idle. It was placed in a premium deposit account, PDA, producing guaranteed returns each year and automatically funding the annual IUL premiums. Joe didn't have to remember anything. He didn't have to worry about business cash flow, and he didn't risk a tax mistake during a strong year. And here's what that structure produced, based on the actual illustration. Total funding is $350,000 over 7 years. Cash accumulated value at age 58, around $829,000. Cash accumulated value at age 63, $1.14 million, and projected loan income starting at age 65 of $114,000 per year. Illustrated loan rate, 6.25%. And the policy remains non-MEC throughout. And there's one detail in those numbers most people miss. And if you miss it, the whole thing breaks. That detail is compliance, without triggering taxable income, without selling assets after market drop, without asking permission. This only works because the structure stayed clean. This wasn't about chasing return. Structure replaced hope. Because at the end of the game, costs don't kill IULs. Bad design does. Joe didn't beat the market. He beat tax drag, volatility, and timing risk. Your business builds income. Your IUL builds freedom. So if you want to know whether your policy or your plan would survive these IRS rules, you can click on a link below and book a tax-free wealth strategy session with us. Because income alone doesn't equal freedom. And remember, it's not what you earn, it's what you keep. Enjoy it.